Welcome to Apartmark Dynamics from MPF Research. Today we're on part 3 of our series on what to watch for in 2013. But before we look ahead, let's take a look back. We told you in a previous video that rent growth for the nation's core 100 markets was 3% in 2012. But how do those stats vary from one place to another? We'll highlight the leaders and laggards, and then we'll jump into the 2013 outlook. Greg Willett is here to help me dive into those numbers. And Greg, we're going to be very list heavy today, so why don't you get us started with the best of the best metros from 2012 as relates to rent growth.
Jay, when starting at the top, you look at the San Francisco Bay Area. The 3 metros in that part of the country are in the top 3 spots. San Francisco, number 1, with annual rent growth of an even 8%, just edging out the 7.7% increase in San Jose. And then Oakland's up next with 7.1% growth. Those are great numbers, but I'll point out in both San Francisco and San Jose, the numbers are down a little bit from double-digit levels in 2011. Unlike in some other areas, I think the political process actually got involved here. You had some local groups that were pushing for rent control in the Bay Area, and so I think some operators intentionally took their rent growth numbers down just to avoid dealing with that issue.
And then in the next group outside of the Bay Area, Denver, Boulder is at the top, 5.9% rent growth in 2012, and then Nashville and New York in a tie for the number 5 position in the country, 5.1% rent growth in both of those spots. And in that group, there are a couple of metros that have been really consistent performers of late, Denver and New York. Both have ranked among the nation's top for rent growth for quite a while now. Nashville's numbers, we've seen a lot of fluctuation in the rent growth numbers there, and that largely reflects the fact that we've seen a lot of construction in the Nashville market as developers have really been drawn to Nashville of late. But the big picture story for Nashville is certainly a very good one, and the outlook there is very strong. So this will see some bumps in the road as lots of new supply works through lease up, but the long-term outlook should remain very strong for Nashville.
We wrap up our top 10 group with Houston at 4.8%, Charlotte at 4.6%, Portland 4.4%, and the Seattle-Tacoma area at 4.3%. Jay, for me, the interesting one there is actually Portland. It's not a big construction market in the big picture, but you actually did have a lot of delivery specifically right at the end of 2012. Didn't seem to hurt their performance at all, and as we go into 2013, this is one of the few markets nationally where you will deliver fewer units in the coming year than you did in the past. And so that really suggests they're going to sustain some strong momentum.
And a few more markets for you. These are some large markets that just missed the cutoff point for the top 10 rent growth nationally. Pricing jumped 4.1% in Detroit, 4% in West Palm Beach, 3.9% in Austin, so some significant cooling there, and 3.7% in Orange County.
As we're taking turns here, I guess that turns it over to me to talk about some of the laggards. And so the worst performers in terms of rent change among the big markets, and notice I did say rent change because we do have one that is negative. At the bottom of the list, we've got Las Vegas, where rents were cut 1.7%. And then some ones where the shift was just barely positive. Less than 1% in Virginia Beach, Norfolk, New Orleans, and Riverside San Bernardino. And then both Hartford and Atlanta came in right at that 1% level.
So that takes us to the big question, what happens with rents in 2013? And Greg, as we've been pouring through forecasting updates these past few days, one of the things that jumps out is how little our expectations have changed for this year ahead. Our overall rent growth number for the top 100 markets is right at 3.2%. Pretty much in line with the 3% number for 2012. And those lists of top achievers and bottom markets really don't seem to be changing much, at least in our outlook. So have we just been lazy?
Well, maybe a little bit, but I don't think we have. And that really stems from the occupancy outlook is very steady in pretty much everywhere. But one thing that we do see as we're doing the forecasting is that there are some markets where it's a broader range of possibilities, some with some upside potential and some with some downside risk. So maybe we should talk about those a little bit.
Well, I'll start with the upside potential markets. And the ones that really stand out for us as ones that could see some significant momentum in the next year include Los Angeles, Orlando, and the South Florida metros. What we've seen in those metros is that occupancy has gotten back to the levels that we have normally have expected to see compared to pre-recession levels, but rent growth just hasn't kicked into a higher gear. And the more aggressive price positioning has just been slow to come. And some of the operators are definitely trying to push that rent growth pace, but confidence is low, and so they're backing off when there's even the slightest blip in momentum. The flow of prospects coming through the front door lulls for a week or two. Residents exhibit some pushback on higher pricing when leases come up for renewal, and the property across the street is holding rents at a lower rate. And so folks just seem ready to latch on to any reason to play defense rather than to play offense. But at some point, pricing acceleration is going to come back in brief fits and spurts, and those should stick at some point as confidence comes back at higher levels and we start to see more sustained momentum.
Yeah, I agree with that. And a couple more that I would put in the upside potential category would be New York and northern New Jersey, and that really comes down to the after effects of Superstorm Sandy. As we've talked about earlier, when one of these natural disasters occurs, you don't really see a lot happen immediately in terms of pricing change. But as you get a little bit further into the cycle and you stay really tight and leases start coming up for renewals, it's not unusual to get a little bit more aggressive than you have been.
And then let's shift gears to the downside risk category. And this list is heavy on markets with lots of construction and lots of supply that's coming online in 2013. Washington, D.C., for example, one that's already started to experience a significant slowdown in rent growth. And you know it's on the way for Austin as well. And I mentioned earlier a slowdown there. We don't think that the outlook is significantly downgraded for Austin. Supply is not going to be a really major issue by Austin standards until 2014. But when we're talking about this downside risk group, it's an array of metros where building is really aggressive in some submarkets, but minimal in others. Thus, you don't know whether the slowdown in rent growth will be contained to certain pockets and to the top tier of the market, or if that'll spread to the metro as a whole. And so key places where we're looking at this might happening include places like Seattle, San Jose, Orange County, Raleigh-Durham, and Nashville.
And another group that we would probably put in the downside risk category would be the markets where we think that the potential loss to single-family home purchase is a little bit dangerous. In a previous video that we just did, we talked about the fact that a comeback in the for-sale housing market is probably good for the apartment sector overall, but there are a few spots where the math is a little bit trickier. We've already seen that loss to purchase has slowed down the momentum for apartments in Phoenix, and a couple of other ones that really seem vulnerable to moving into that category as employment growth gets stronger would be Atlanta and Tampa.
So that wraps us up for our discussion on rent growth potential in 2013. So until next time, for NPF Research, for Greg Willett, I'm Jay Parsons. Thank you for watching Apartment Market Dynamics.
Want more? Go deeper with NPF Research's apartment market reports. From a national level, down to individual metros, to specific neighborhoods, NPF Research has been providing unparalleled apartment market intelligence to the multifamily industry for almost 5 decades. Learn more by contacting us at 877-284-4938 or visit www.npfresearch.com and click on Market Reports.